Welcome back to the Daily Crypto Roundup. Today's crypto market has got one very clear message for us. Risk appetite has not disappeared, but it has become extremely selective. Money is still moving. Investors are still buying. The stock market is still finding places to run. But right now, crypto is not getting the easy bid. And that is the big story of the day. Bitcoin is still trying to hold the line around $60,000. Ethereum is sitting near $1,600. XRP is around $1.07. Solana is just above $72, and the wider altcoin market is still under pressure. Dogecoin and Hyperliquid's hype were among the biggest weekly losers, both falling close to 10%, while Ethereum dropped more than 8%, and XRP was down nearly 8% over the week. Bitcoin held up better than most, slipping just over 5%. But even that tells you where we are. The market is cautious, traders are nervous, and capital is being very picky. And before we get into it, a quick reminder. This show is supported by Kraken. We've got the Kraken link in the description, and if you are trading crypto and want to support the show, using that link genuinely helps us keep this going. We are also giving away 20 XRP to listeners who sign up through the Kraken link. As always, this is not financial advice. Crypto is risky, prices move fast, and you should always make your own decisions. But if you already use crypto platforms and you want to support the podcast, we really do appreciate it. Now let's start with the market itself, because the strange thing about this week is that it does not feel like a full risk-off panic. Normally, when crypto is getting hit this hard, you look across the market and see everything getting smashed. But that is not really what happened. Wall Street has still been finding buyers. The equal-weighted S&P 500 even hit a record, which basically means the gains were not just being carried by the biggest few companies. A broader group of stocks has been doing well. The problem for crypto is simple. It is not part of the rotation. That is important. Because this is not just people running away from risk. It is people choosing a different kind of risk. AI stocks and companies linked to artificial intelligence are still getting the attention, even though some of the big chip names have started to wobble. The market is saying, we still want growth, but we want growth with a clearer story. Crypto, for now, is being treated as the messy part of the risk market. And that is why the Bitcoin level matters so much. Bitcoin dipped towards $58,800 on Friday, but buyers stepped in and pushed it back above $60,000. Alex Kupcikevich from FX Pro told CoinDesk that the move looked like margin liquidations during downtrend spikes, followed by strong buying on pending orders during the recovery. In plain English, leveraged traders got flushed, the market got hit, and then buyers came in at the lows. That is not a clean bullish breakout, but it is also not total collapse. It is a market trying to find where real demand is. The problem is that the pressure has not gone away. US spot Bitcoin ETF outflows, a hawkish Federal Reserve, and a stronger dollar have all weighed on crypto this week. That is a nasty combination. ETF outflows remove one of the big institutional support stories. A hawkish Fed hurts speculative assets, and a strong dollar usually makes investors less desperate to chase alternatives. So when you put all that together, you get exactly what we are seeing. Bitcoin hanging on, altcoins bleeding harder, and traders waiting for a clean signal. And that brings us to Michael Saylor and strategy, because this is probably the most important structural story in crypto right now. For years, strategy traded at a premium to the value of its Bitcoin holdings. That premium was the magic. It allowed the company to raise capital, buy more Bitcoin, watch the stock run, raise more capital again, and keep the machine going. But now, according to CoinDesk, Strategy's enterprise NAV has fallen below 1. That means the market is now valuing the company at less than the value of the Bitcoin it holds. Strategy's enterprise value was around $50.4 billion, while its Bitcoin holdings were worth around $51.1 billion, with Bitcoin near $60,000. That is a huge change in the story. When the stock trades above the value of the Bitcoin, issuing shares can be accretive. It can make sense. But when the stock trades below the value of the Bitcoin, Issuing new equity becomes much harder to justify because you are effectively selling a claim on the assets at a discount. That is why people are now asking whether Strategy is starting to trade more like a closed-end fund than a high-growth operating company with a Bitcoin treasury strategy. And this is where the debate gets spicy. Some people will say this is the market finally punishing financial engineering. Others will say Strategy still has tools available. It can manage debt, refinance, use preferred stock, use software cash flows, and wait for better conditions. But the reality is this. The flywheel has slowed down. The machine that looked unstoppable in a bull market suddenly looks a lot more fragile when Bitcoin is falling and the premium disappears. That links directly into the next story, because Ripple CEO Brad Garlinghouse has come out and said he is still bullish on Bitcoin, but he believes Michael Saylor's strategy has hurt the broader crypto market. In a CNBC interview, Garlinghouse argued that financial engineering does not drive long-term value, and that real value comes from usefulness. He specifically criticized Strategy's preferred stock funding model and pointed to the weakness in STRC as evidence that the model is under pressure. STRC carries an 11.5% annual dividend and was designed to trade near $100, but it has fallen roughly 25% below that level. That matters because if Strategy is using preferred shares as part of its Bitcoin buying engine, and those shares stop behaving the way the model needs them to behave, the whole process becomes less efficient. CoinDesk also reported that Crypto Quant said Strategy should pause Bitcoin buying and rebuild cash reserves, while benchmark StoneX analyst Mark Palmer argued the funding engine has become less efficient rather than completely broken. That is the fair way to frame it. This is not necessarily the end of Strategy. It is not necessarily the end of Saylor. But it is a major stress test. And for crypto, it matters because Strategy became one of the biggest symbols of institutional Bitcoin conviction. When that symbol comes under pressure, it affects sentiment far beyond one stock. But here is the other side. Garlinghouse saying he is still bullish on Bitcoin is important. He is not attacking Bitcoin itself. He is attacking the structure around the trade. And that is the distinction we should keep making. Bitcoin the asset, Bitcoin the network, and Bitcoin treasury company leverage are not all the same thing. One can remain strong while another breaks down. Next, we have to talk about Polymarket, because this is the type of story that hurts confidence at exactly the wrong time. Hackers stole around $3.1 million in Polymarket's PUSD token from 11 user wallets, according to blockchain intelligence firm AML Bot. The stolen funds were reportedly moved from Polygon to Ethereum, and Polymarket said a compromised third-party vendor injected a malicious script into its front end for some users. The platform says it removed the affected dependency and pledged full refunds to affected PUSD holders. Now, to Polymarket's credit, promising full refunds is the right move. But the bigger issue is trust. Prediction markets have been one of the more exciting sectors in crypto because they actually show a clear use case. People trading on real-world events, politics, sport, economics, elections, and basically anything with an outcome. But if users start thinking their wallets can get drained because of front-end vulnerabilities or third-party dependencies, that becomes a problem. And this is not happening in isolation. CoinDesk noted that Polymarket has had other recent security issues, including a suspected March breach and a December incident involving suspicious login attempts. On top of that, the platform is reportedly under federal investigation over alleged deceptive social media promotions. So Polymarket now has two battles at once: security trust and regulatory trust. That is not ideal, especially when the broader crypto market is already fragile. But again, this is where we need balance. These problems do not mean prediction markets are dead. They mean the sector is growing up in public, and growing up in crypto usually means getting punched in the face several times before the infrastructure gets stronger. The opportunity is still there, but users need security, transparency, and a reason to believe the platform can protect them. And then, just when everything looks gloomy, Cathie Wood appears with a massive buying headline. ARK Invest bought around $25.54 million worth of shares in Coinbase, SpaceX, Circle, Bullish, and Robinhood across several of its ETFs. Coinbase was the biggest purchase, with ARK buying 68,366 shares worth roughly $10.19 million. SpaceX was next at about $7.01 million. Circle came in at around $5.79 million, and there were smaller additions to Bullish and Robinhood. This is interesting because Cathie Wood is not buying random crypto tokens here. She is buying the infrastructure and equity side of the crypto economy. Coinbase, Circle, Bullish, Robinhood. These are companies that could benefit if crypto activity comes back, if regulation becomes clearer, and if institutional adoption continues. It is a different way of expressing a crypto view. Instead of buying the coins directly, ARK is buying the rails, the exchanges, the stablecoin businesses, and the platforms. And that is actually one of the themes of this entire market. Capital is not gone. It is just being more selective. Traders might not want to ape into every altcoin right now, but major investors are still positioning around the long-term growth of the sector. ARK has also been adding to these names after recent share price declines, including more Coinbase and SpaceX earlier in the week. Cathie Wood also continues to push back against the market's inflation fears. She has argued that underlying inflation is much lower than many people think, pointing to productivity and labor cost data, as well as real-time inflation measures showing inflation much lower than the peaks of 2022. Whether you agree with her or not, the logic is clear. If inflation cools, the Federal Reserve eventually gets room to ease, and high-growth assets could come back into favor. So where does that leave us today? It leaves us in a market that looks ugly on the surface but is not without hope. Bitcoin is under pressure, but buyers are still defending the high $50,000. Altcoins are hurting, but that is normal when liquidity gets tight. Strategy is facing a serious test, but the Bitcoin thesis itself is not the same thing as the strategy funding model. Polymarket has a trust problem, but prediction markets still have a real use case. And while retail sentiment feels weak, Cathie Wood is still buying crypto-linked companies into the fear. The verdict for today is this: crypto is not dead, but the easy money phase is clearly gone. This market is demanding stronger narratives, stronger balance sheets, stronger security, and stronger proof of use. The hype coins are getting punished. The leveraged treasury plays are getting questioned. Platforms with security issues are being forced to prove themselves. And investors are moving towards the parts of the market that look most durable. That might feel brutal, but it is also how healthier markets are built. The next big thing to watch is whether Bitcoin can keep holding that $58,000 to $60,000 area. If it can, then this might end up being another painful shakeout before a recovery attempt. If it loses that zone cleanly, then the market could start pricing in a deeper move lower, and altcoins would likely feel that even harder. But for now, the message is simple. Stay calm, stay selective, and do not confuse short-term fear with the end of the story. Crypto has been through far worse than this. The weak hands are being tested. The leveraged trades are being flushed. The narratives are being separated from the noise. And when that process is finished, the strongest assets and the strongest businesses are usually the ones left standing. That is where the opportunity normally begins. As always, none of this is financial advice. Do your own research, manage your risk, and never invest money you cannot afford to lose. And if you want to support the show, check out the Kraken link in the description. We are giving away 20 XRP to listeners who sign up through that link, and every bit of support helps us keep bringing you these daily crypto updates. Thanks for listening, enjoy the rest of your day, and we will see you at the top.